Let every man divide his money into 3 parts and invest 1/3 in land, 1/3 in business, and keep 1/3 by him in reserves. That is the Talmud Portfolio. It is an investing recommendation that has been around for literally thousands of years, that originated in the Talmud, which is a collection of texts written by Jewish rabbis thousands of years ago. We are going to be discussing what each of those 3 categories mean, what they don't mean, why this investing strategy in this portfolio is potentially so effective, especially when you compare it to the standard alternative. Let's dive in. Thanks for tuning in, guys. This is Heresy Financial. My name is Joseph Brown, and I started this channel to offer education, insight, news, and talk about topics that the mainstream financial outlets are not really discussing, and talk about it in a way that will ultimately help you make money better, safer, with less risk, and more effectively. Now, I've talked about it on this channel before, but it applies really well to this specific strategy, the Talmud Portfolio. And that's the Linde Effect. And if you've never heard of the Linde Effect, it's a fascinating phenomenon that we've observed in all facets of really the universe, not even constrained to just human life. The longer something has existed, the longer you could expect that it will continue to exist into the future. Now, obviously, this doesn't apply to things or beings that are governed by entropy, things that break down over time. Obviously, it doesn't apply to, human life. If somebody has lived 70 years, you wouldn't expect him to live another 70 years. You'd expect him to live maybe another 5 or 10 years. But with effective practices or ideas, or a lot of times even buildings, the Linde Effect applies. Now, the Linde Effect was coined because of a deli in New York called Linde, and actors there discovered that Broadway shows, if they had been on Broadway for 100 days, they could expect that show would stay for about another 100 days. There are 2 reasons why the Linde Effect works. The first one is talked about extensively by Nassim Nicholas Taleb. It's called anti-fragility. And basically it means that if something has the capability to live a long time, it's been subjected to multiple tests and attempts at destroying it and volatility. And if it's survived all of that, and the longer it's been around, the more it's had to survive, the more it's been subjected to and still come out surviving, the more you can expect that there won't be that many new things that the universe or life can throw at it that would be able to destroy it, since nothing has in the past. A good example of this is the prediction of the lifespan of the Berlin Wall versus the lifespan of the pyramids by Richard Gott a few decades ago using this model. Looking at the Berlin Wall, he predicted it would last another 10 to 12 years or so. I can't remember exactly what the prediction was, but it was just basically it had existed for about that long, and he predicted that that's about how much longer it had in its lifespan before it would be torn down. On the other hand, he looked at the pyramids and said they would continue to exist for another 4,000 or 5,000 years or so. He was within 1 or 2 years on his prediction on the Berlin Wall, and obviously the verdict is still out on the pyramids, but so far they have outlasted the Berlin Wall at the very least. And so that is one of the reasons why this prediction model works, and why older things tend to outlast newer things, just due to the fact that they've been around longer and they've been subjected to more things that could have destroyed them, destroyed other things, but didn't destroy them. Therefore, something about them is inherently stronger, and they have that internal capability, that inherent survivability that will allow them to continue far into the future compared to the newer untested things. The second reason is just mathematical statistical probability of any given item that you look at in the aggregate of all given items that are in their lifetime of existing. So things that have already started, so they're above 0% of their lifespan, but they're below 100% of their lifespan. They haven't yet ended. Because nobody can see the future, you can't actually predict how long something will exist, or, said in other words, how far along you are in its total percentage of its life. Therefore, just due to statistics probability, you have an equal chance of being at 1% of something's life versus 99% of something's life, 2%, 75%, or anywhere in between. This means when you aggregate all existing things and are going to try and make predictions about where you are in the lifespan of any given object, on average, when you average out all the things that are at 1% of their lifespan versus all the things that are at 99% of their lifespan and anywhere in between, on average, you are sitting at a 50% lifespan of any given object. So mathematically speaking, if you are looking for the most probable prediction on how much longer something will last, mathematically speaking, your best bet is to just guess that you are at 50% and that it will continue to exist for just about as long as it has already existed. Now, I've talked about this extensively in my discussions about gold versus unbacked fiat currencies versus things like cryptocurrencies like Bitcoin. However, I want to look at this in light of the Talmud Portfolio. Now, the Talmud Portfolio, you might look at it and think, hey, well, this was, yes, it was a really old recommendation, but has it actually been used and has it actually been effective for the last thousands of years? Because just because we can find an ancient document that says something doesn't mean that that's actually a theory or a practice that has that Linde effect that is actually effective and will continue to be effective for a very long time. And with that, I will point you to ultra high net worth family offices, and they found in studies like this one I'll show you here that the vast majority of ultra high net worth portfolios do replicate pretty closely the Talmud Portfolio, the general breakdown of a third in business, a third in reserves, and a third in land. So we know that this was something that has been recommended by scholars for at least a couple thousand years, and we can see that ultra high net worth family offices continue to use this portfolio breakdown even today. So it's not just something that's being tried out by schmucks. But as with any investing strategy, there are going to be some disagreements on exactly how to implement it. And this Talmud Portfolio is no different. So first, let's look at the third in business. Now, this one, most people agree on. It is fairly self-explanatory. Most people are looking at stocks for this. Now, keeping in mind the original context, there weren't these giant, efficient electronic exchanges with publicly traded companies 2,000 years ago. So what they were usually referring to was investments in small local businesses. Usually it was your own. And so if you're the type of person that just goes to work, keeps your head down, saves a lot, invests a lot, keeps living within your means, and you're doing the typical Dave Ramsey plan, publicly traded stocks are going to be fine, and ETFs and mutual funds that include publicly traded stocks are going to be what represents this portion in your portfolio. Just recognize that in the context of how this has always been applied, it looks at your overall whole entire picture, not just what's in your 401k. So if you're somebody who's an entrepreneur, you've started a couple businesses, you're trying to go into business for yourself, you're branching out, your business that you own and operate, take it all into account. 33% in business, whether that's publicly traded stocks or your own personal company. The second portion of this is going to be real estate. In the Talmud, it says land, and pretty much everybody interprets that as real estate investing. Now, this is where you enter a little bit more controversy, because with real estate, you can look at your personal residence, you can look at investment real estate like rental properties, but you can also look at REITs, REITs, real estate investment trusts. And those are basically like mutual funds or ETFs that invest in real estate for you so that you can have access to real estate investing through things like your 401k or your brokerage account. Now, I know I am definitely far from the first person to say this, but you don't hear this from your typical financial advisor. You should not be using REITs as your real estate exposure. If you just look at the raw total returns of real estate, even including cash flow, they're not, over a long period of time, they're not normally going to come close to typical stock market returns. But that's because hardly anybody invests in real estate that way. The biggest advantage to investing in real estate is the tax benefits that you get to do so. And the vast majority of those tax benefits are reduced or eliminated when you invest in real estate through things like REITs. One of the other advantages that you have when investing in real estate is the fact that you can do insider trading. You can trade on insider knowledge. You can get into things that aren't public information through friends or contacts or real estate agents. You can control the investment. You can control the appreciation by putting in sweat equity, building on additional bedrooms, upgrading the kitchen. There's lots of things you can do to control that real estate, control that appreciation, and control the cash flow. So all of these benefits that are associated with physically owning and direct ownership of real estate as an investment are almost entirely eliminated when you get into things like REITs. And so because of that, long term, REITs don't really have that great of returns because they're a lot more of an efficient investment because they're publicly traded. So you don't have the opportunity to put in money at value prices. And you don't have the control. You can't go in and add new kitchens to the apartment complex units inside of a REIT. So while most financial advisors and most portfolios that are automatically allocated portfolios will have some of your money invested in things like REITs, it's a pretty terrible way to have your allocation of money invested in real estate. It doesn't provide near as much of the advantage as physical real estate and direct ownership of physical properties has. Now, the other portion that is up for debate inside the real estate bucket is going to be personal home ownership. Most people have the vast majority of their net worth tied up inside their homes. And so if you're in the standard mainstream plan of go to work, buy a house, put money in your 401k, then for you, yeah, your personal residence is probably going to be that 33% portion. But even if you classify your personal residence as an investment, it's a pretty bad investment because the only thing you're counting on is appreciation. It's kind of like the greater fool theory. You're just banking on the fact that you're going to be able to sell the same thing to somebody else at a greater price. There's no cash flow. And even if you own the house outright and don't have any debt on it, so it's not costing you in terms of mortgage principal and interest, you still have to pay taxes and insurance and maintenance on the property. So ultimately, personal residences, they cost you money. Therefore, they're a really bad investment if you classify them as an investment at all, which you know I don't. It doesn't provide you cash flow. Therefore, it's not an investment in my book. Now, the third category of the Talmud portfolio is going to be reserves. And to be honest, there's not a lot of controversy about this because the vast majority of people who even talk about the Talmud portfolio are typically mainstream financial advisors or economists. And so the vast majority of them are just looking at reserves as things like cash or bonds. But here's the thing. You have to remember the context in which this was written. And for the last 3,000 years at least, money has always been gold. There have been periods of time when currency has existed in circulation, but it's always been redeemable in gold, and the isolated circumstances when there has been too much currency issued compared to the gold in demand, there have been bank runs, local economic crises, and so uninterrupted for the last 3,000 years at least, there's been a gold or silver standard somewhere in the world. Up until 50 years ago. And ultimately, the real redeemable gold standard did end a few decades before that when FDR ended the ability for US citizens to own gold or redeem their dollars in gold. And the Bretton Woods system established the gold exchange standard so other central banks and major institutions could exchange dollars for gold. And then that ended in 1971 when Nixon closed the gold window, which meant that all money in circulation was just paper. And that was followed by massive bouts of inflation all over the world. And so when you understand the context of when this was written, that gold was money, and there was really no concept for people thinking that paper might be considered money, this is what gives this portfolio a massive advantage. Because when you compare this portfolio considered the mainstream way, where this cash, this reserves portion is going to be cash or bonds, its long-term return is going to be somewhere around 10%, which is good. And it has a lot less volatility than some of the other standard portfolio recommendations out there like modern portfolio theory. But there's a massive drag on this portfolio if you do have a third of your money in cash or treasuries or bonds, because inflation is going to drastically reduce the purchasing power of that portion of your account. And so when they were originally talking about keeping a third of your money in reserves, they were talking about keeping a third of your money in gold. Now, for practical purposes, you're not going to be able to keep all of your money in either gold, real estate, or stocks. You're going to have some cash currency just to pay the bills. And maybe for you that looks like 10%. But ultimately what this portfolio was referencing in reserves was gold. And you might think, hey, but wait, let's look at that. It said keep by him in reserves. And if you look at the surrounding text around this portfolio recommendation in the original texts, they make it clear that you're supposed to have your reserves close to you nearby so that you are ready to deploy it when the opportunity arises. If there's a deal on a business or goods or services and you need to buy something very quickly. So you think, how am I supposed to have a third of my money at hand in gold? Well, take a look at this. This is a picture of different sizes of gold bars. Now, all the way at the bottom, you have this tiny little 1 gram gold piece. And I can't even call it a bar, even though it's in the shape of a bar, just because it's so small. That tiny little 1 gram gold fleck over there, which is about the size of a fingernail, at current gold prices is worth about $50 US. Now, go on up till you get to the 1 ounce bar. That 1 ounce bar at current prices is worth about $1,500. Now, that 1 ounce bar is about the size of 2 quarters smashed together. Now, think about that. Smash 2 quarters together and imagine $1,500, and you can see where gold starts to pack in some serious value for its size. Now, let's go all the way up to that big bar that you see there. That is a 1 kilo or 1,000 gram bar, which at current prices is worth just about $50,000. And as you can see, it's just about the size of an iPhone. So if your total net worth is $150,000, you have $50,000 in a small rental property, and you have $50,000 in stocks, you can then have $50,000 in 1 gold bar the size of an iPhone. You think you don't have enough room somewhere to store an iPhone? Now let's take it up a notch. Let's say your net worth is $1 million. And you want to abide by the Talmud Portfolio investing strategy. That means you're going to have just about $333,000 that you are going to want to allocate to gold. It seems like a lot of money. That is 7 iPhones worth of space. Size is not really an issue in terms of storage space. A really good safe, bolted to the ground, hidden in a wall, out of sight, is going to do the trick. You're not going to be running out of closet space storing these gold bars. Now, obviously, you might be thinking, hey, what about vault storage? Because I don't really want to be storing that much gold just in my house. Somebody could steal it. The house could burn down. Oh, I'm glad you brought up the house burning down. The average house fire is just about 1,500 to 1,600 degrees Fahrenheit. Gold melts at right around 1,900 degrees Fahrenheit. So even if your house burns down, your gold will stay there in its form, won't even melt. And even if your house fire gets up to that temperature, you're just going to be left with a melted blob of gold. It's not going to burn away. It's just going to melt and then reform when the house fire dies. Oh, and as a side note, just in case you're interested in investing in diamonds as another way to diversify and have some of your money concentrated into a small size, diamonds will burn at somewhere in between 1,500 and 1,600 degrees. And so your average house fire will actually burn away your diamonds. So no, diamonds are not forever. If you have a house fire, literally your diamond ring, your wife's diamond ring will be sitting there and the diamond will burn up and the gold ring will still be left behind. Also, diamonds aren't actually that scarce. That's an artificial scarcity by the miners. They don't release as many diamonds as they did. And if they did, diamonds would be worth almost nothing. Diamonds are extremely common in nature. But enough about diamonds. This is the Talmud Portfolio, and its recommendations have been around for thousands of years, and they were good enough at the time where it made it into the Talmud, which is this collection of teachings by these rabbis, and it survived. And if you question Jewish ability to make wise financial decisions, I shouldn't even have to say this, but just think of your average typical Jewish stereotype. You typically think of the average Jew as being fairly good with money. They're usually the ones that in the stereotypical depictions are the bankers and the financiers. And so historically, as a people group, they've been pretty good with money. Now, I'd like to put this in contrast to the modern portfolio theory. Now, the modern portfolio theory, you might think is pretty similar. It just has a lot more small categories inside each of these categories. But there are actually some fundamental issues with the modern portfolio theory, one of which is the fact that it makes some assumptions about the nature of financial markets that just are not true. It assumes the efficient market hypothesis, which says that really that there's no new information, that there's no information that you can find that's not already priced into the market. So therefore, valuations are actually what they are because that's what the market has priced something at. But if that was true, you wouldn't have things like flash crashes, you wouldn't have things like melt-ups, because ultimately in these fast-moving markets, you're not seeing anything fundamentally change with the nature of the businesses themselves that are selling off or melting up, or with the economic environment. And so it's not really true that markets are actually efficient. Yes, it's true that the consensus has priced it there, but in reality, the consensus can be wrong, and the consensus can be very wrong. The second thing that it assumes is that financial markets have a Gaussian curve to them, or what's known as a normal distribution. And again, that's not really true as well. Financial markets have complex dynamics, which means that they're governed by power laws and power distributions, not normal distributions. This means that in their models, their prediction of rare events, which is taken into account when determining how risky they want your portfolio to be, are completely off, because in reality, these rare events happen all the time, far more often than the financial models say they should. So if you start to see a 100-year flood happen every 10 years, or a 1 in a million year event happen every couple of decades, then your models of prediction are probably just a little bit off. And lastly, modern portfolio theory confuses volatility with risk. And that is a massive error. Volatility and risk are not the same thing. In fact, some of the financial instruments that have the lowest volatility are really just masking enormous blow-up risk. And yes, a lot of times it does involve fraud. Think of Bernie Madoff. His returns were extremely low volatility. They were extremely predictable. Every year, I think it was just like 12.1%, I believe, was pretty much his return every single year for decades. And the only reason he got found out is because those consistent returns persisted during times when people started to say, that's not possible right now. How can you maintain those consistent returns when everybody else is not? Now, good long-term returns are possible, obviously, but they usually come with a lot of volatility. And that's what I'm getting at here. Some of the safest investments that are actually safe come with a lot of volatility. And some of the investments that look the safest, let's say CDs that are FDIC insured, they actually have risk that at any moment there could be a run on all US banks, and we could have a banking holiday, and FDIC might not be able to cover the liabilities, and you could be out your money. Or if you're not actually out those dollars, they're just going to print those dollars in order to redeem them, and all of the printing will drastically reduce the purchasing power. So in reality, your purchasing power is not preserved, even though you got the same number of dollars back. Everything else got a lot more expensive. And this is the biggest reason why I talk so much about why cash and bonds and CDs and fixed income investments are some of the most dangerous investments out there, because yes, they have low volatility, but really what that's masking is big blow up risk. And finally, modern portfolio theory is going to shift your investments into the more conservative, low volatility, low risk investments as you get older, which means that as you get older, you're actually taking on more and more and more blow up risk in your portfolio in exchange for low volatility. Versus something like the Talmud Portfolio, there's no adjustment or recommendation for adjustment as time goes on as you get older, because you already have a massive amount of your money in cash flow producing assets. So you have the income. You have a massive amount of your money in growth potential investments like business and stocks, and you have a massive amount of your money in reserves that's really not going to change in value. It might change in price, but it doesn't change in value. 1 ounce of gold will buy you roughly the same amount of stuff today as it did 2,000 years ago, even though the dollar amounts or whatever currency amounts you're measuring that in have changed drastically along the way. So obviously, I'm not recommending this portfolio. I just wanted to explain it because when I first found out about the Talmud Portfolio, I really enjoyed what I learned about it, and it provides a lot of insights into what the ancients were thinking about, and people and smart investing minds have been considering and distilled and boiled down for thousands of years. And the older the wisdom is that has survived, the more likely it is that it is wisdom that you can rely on. Thank you so much for watching. I know this was a longer video. If you did like the content, help out the channel, hit that like button, hit that subscribe button. You guys have a great day.